Good morning, ladies and gentlemen, to this wintry day. It's getting a bit chilly, and as always, I'm back live with Doc Andrew Wilson. Good morning, Doc.
Yes, good day, Graeme, and I guess we're just about to farewell to the old financial year. So next week I'll be saying Happy New Year, Graeme, because it'll be the next financial year. So I hope everybody's focusing on their tax returns. I know I am right at the minute. But you're right, Graeme, it is very wintry at the moment. In fact, I think we're getting a lot of rain on the eastern seaboard as we speak. A lot of rain in Sydney, Melbourne and Brisbane, I believe. So, but that's winter for you, isn't it? Maybe not so much in Brisbane, but certainly Melbourne and Sydney can get the odd spot of rain. And also in Melbourne, it's been pretty damn cold, let me tell you as well.
We might just have to embrace it and hit the slopes and go for a snow or a ski, Doc.
Yeah, okay, whatever. But I'd rather have the sunshine, mate. Just a little frosty there with the snow. And, give me some sunshine. So I might be heading up north there sooner rather than later.
You'll have to come join us, Doc. Well, tell me this. Has the market become frosty?
Yeah, perhaps a little bit. But, of course, we expect this, Graeme. We've had a great run and we've got a great show today. We have the latest data, and we're going to have a written. It's not a sneak preview. It's actually the full data set that will be released in 2 days' time. It is the June quarter house price data, house and unit price data. So we're going to have a look at that. And gee whiz, what a first half of the year it's been. Not just the June quarter, but the first half of the year has been. I guess we could say a strong result, all things considered. And prices are continuing to rise, and we'll have a look at that. But, of course, as we mentioned, it's the end of the financial year. We're in the middle of the year, and, of course, that means July. And July, as you suggested, Graeme, is frosty, not just in terms of the weather, but also, of course, housing markets become distracted. School holidays commenced this week in Melbourne and Brisbane. Next week they'll be off in New South Wales, Sydney and Adelaide. So everybody's hitting the slopes or heading for Europe or doing whatever they do, or just hunkering around the heater at home. But it does mean that, the energy is sort of dissipating out of the housing market after a great run through autumn. And everybody will start thinking pretty soon about a spring selling campaign, Graeme, or a spring buying campaign. So that's the way it works here. We have those two seasons, autumn and spring. And they are punctuated basically by July and into August by, I guess, a bit of think music happening in terms of those start to focus on the end of the year. Let's get that new house done and dusted by the end of the year. Let's get our house sold and let's get our new one all moved into by Christmas. So that's the focus that happens mid-year, Graeme, and that's why we see all that energy through spring, and that's why it's called the spring selling season. And it is the strongest, typically the strongest part of the year for buying and selling properties is that second half of the year, particularly the last 3 or 4 months. So we've got that to look forward to, but a great springboard to start, Graeme.
And I think, Doc, it's important for people to understand, just to be very clear over the coming weeks, we expect the market to soften. We expect, using auction clearance rates is a good method to track home price value. We expect there to be less amount of properties going to auction. We expect out of that lower amount of stock for sale, we expect less sales. Sydney been sitting in that 80% mark. It may drop 70, 65. We expect it to drop somewhat, Doc. Can we just touch on that quickly so people don't go, oh, the market's crashing? Well, no, it's typically colder. People aren't as active. Can we just sort of touch on that before we rip into the data?
Yeah, of course, Graeme. And, the point is, I guess, if we do get those doomsayers running back out saying, yeah, we told you so, well, they're going to have to, start scraping all the egg off their face come September because it is just the seasonal easing in market activity. The other thing we see, Graeme, and I think it's important to point out in terms of the mid-year market, is that we typically see less discretionary sales in the market through this period. In other words, it is a period of rest and reflection. It is the point between the autumn and spring selling seasons. But you still get those that have to sell their properties, those that, are transferring interstate, that have a divorce or sadly a death. And therefore, they have to meet the market as it is. And as you said, there are fewer buyers, so there's less competition. So that tends to put downward pressure on prices through this period because there is less discretionary buying and selling going on. And the other point is that we also see fewer higher priced properties as a proportion of the market, Graeme. So we're seeing more lower priced properties in the marketplace because that does reflect to some degree those non-discretionary sellers active in the market. So that it tends to put downward pressure on the absolute price measures, but really it's a change in the mix of properties that are in the market through July. So even saying that, Graeme, I'd still expect us to have, and it'll be interesting to see, still reasonable clearance rates occurring through the July period, because it's still a market where demand is ahead of supply. So there'll still be more buyers in the market through July this year, I believe, than there were in July last year. In fact, it's more of a normal market now, Graeme. We've had a strong autumn, and we have. Now we're having our typical mid-year break between the market environments until we revive again in spring. So, of course, things will, what happens in the economy with interest rates will influence what happens coming into the spring market. But we're going to touch on that to start with today, Graeme. Perhaps some better news on the horizon, and it's always, dangerous to predict interest rates, but particularly with our RBA. But maybe some signs there that
RB who?
Yeah, well, yeah, RB gone maybe, but as I said, I think that we can discuss, and we'll look at that in terms of the latest RBA statements, that there's the prospect maybe just beginning to crystallise of a pause coming up in interest rates. Now that will only help housing markets if we do get a pause, but certainly housing higher interest rates have had a really, except for sentiment over a couple of months last year, middle of the year, it's really had no effect on housing markets, which are all up and running now, Graeme.
I think, Doc, it's so we'll say it's seasonally settled now, but I don't know. Look, there's a lot of families struggling. People are pretty stressed. Absolutely. We're getting thousands of people on free webinars now and events you've been on with us. Yeah. People are screaming and really, really searching for answers at the moment. But it's interesting concerning that we don't search for these answers when we're comfortable. We search when we're very uncomfortable. But this RBA has got a lot to answer for. But I still think, Doc, that at the rate that Australians are spent, we'll have a look today what the data says, but we're still out there spending. Everyone that wants to have a job is capable of getting a job, can get a job. Wages are, I know people think that living costs have gone up and wages haven't caught up, but obviously we're not America. There's time frames and contract law in Australia. So there is a delay in wage increases in Australia that we have to acknowledge. But when it's plausible, people are getting significant pay increases and having to pay more for that skilled labour. So it's interesting times, that's for sure, because I worry too, Doc. We say, look, when's enough with the rates? But maybe they do just need to hit us on the head a couple of final times and really scare us out of spending, get us budgeting, get us off the brand name crap and be practical. Maybe they do need to give us a hit. I don't know. Let's see.
I agree with you, Graeme. I think that there needs to be some consistency in monetary policy. I don't think it can be stop-start. I think that's a mistake. I think you go until you go and then you stop. And that's it.
You've nailed it, Doc. Go until you go, and then this maybe we'll pause. We nearly paused. We didn't. I think you're right. Once you run, you got to run with it. You got to own your decision, good, bad, or indifferent. Own it until the economic policy takes effect. You nailed it. Not stop start.
Exactly. And policymakers will say, "Oh, there's a lagged effect, and we don't. We may go too hard, but we won't know until a couple of months later. So we need to stop and watch and see." But it's a very fine process. Nobody's saying that it's a science. It's an art, and you can miss it, you cannot miss it. But the problem is if you keep starting, you're only going to make the problem worse, perhaps by not reinforcing. The putting on the brakes. This is about putting on the brakes. If you just tap and then put the foot on the accelerator and then tap again, you're really not stopping the vehicle, are you? And I think this is And the forward modelling, the forward indications that reserve banks give as well, I'm not sure that's helpful. All these predictions. I mean, they're pestered to do it from journalists, and that's fine. That's their job.
Yeah.
But if they get it wrong, which unfortunately they do more often than not lately, they look like dills, and you lose confidence in the policymakers. Certainly, the predictions on inflation have been, roundly wrong. Even though inflation's has eased, it's mainly been about a falling price of oil, rather than anything else.
Yeah.
The big picture is not just Australia, but the US as well, is that our economy is stronger today than it was when we started raising interest rates. We've had 12 interest rate increases, and our economy is now stronger than where it was than when we started at zero. So, what's happened? Inflation is lower, but basically inflation has tracked lower following the price of oil, Graeme. So there's a lot of issues here in terms of what policymakers are doing. I 100% agree that they should just go until, they can see it's working and then ease off. They've always got the capacity to cut rates if they feel they've gone too hard.
Gone too far, yeah.
And I think it'd be better to go hard and then cut than to go up, down,
Yeah,
up, down.
What are we now? 4.1. I mean, imagine if we just went. Imagine if we just went 4.5. Go 0.4. Boom. 4.5 is an easy enough. People would go, "Whoa, hang on a minute. Let's
take it easy."
Because actually, Doc, I want to ask, before we get into the data today, and you're right, this stop-start stuff's nonsense. I want to ask you a question. A couple of people have been picking my brain on this. The government flooded, or the banks were flooded with all of this cheap money during COVID, right, to help support the economy. They're getting money at nothing. They left variables alone, but they did all this cheap fixed rate garbage with shitty comparison rates and lots of fees. When you look at all this cheap money that the banks were flooded with and current interest rate rises because of inflation, how much do you think the banks are winning out of this high interest rate environment, this urgent rise when they've got all their cost of funds back there and then all of these rises from their prior cost of funds and cheap money? Do you think we're going to see some of the biggest bank profits on record in the next year or two?
Well, I can answer that with real numbers, Graeme, and I can answer it in terms of the interest rate cycle. Now, the last time we raised interest rates was back in, or we were raising rates, was through mining boom number 2, which, of course, was what saved Australia from the weakness, the economic weakness of the rest of the world experienced following the GFC. We were up and running and booming. And remember those days when the Aussie dollar was worth more than the US dollar, Graeme?
What?
The Aussie dollar was worth more than that pathetic US dollar. I'm just being, here, but it was parity and above. Well, that was because our interest rates were way higher than anywhere else in the world. And the reason our interest rates were higher is because we were in the midst of a massive boom, mining boom, exporting iron ore and coal to China. Of course, everybody wanted a piece of the action, so they were buying Aussie dollars because of all our higher interest rates. That's where you put your money, guys. Put it in Aussie, right? Because its interest rates are higher than anywhere else. And, of course, that finished. But when we peaked back in 2012 with our interest rates, because, of course, the mining boom ended and we then joined the rest of the world having to cut rates, because we couldn't get our economy up and running following the end of that mining boom. But we peaked at just under 5% official, right? The RBA rate peaked at that cycle. It was 4.85%, I think, at that time, but just under 5%. Now, our average mortgage rate then was around about 7%. Now, when we look back now, as you mentioned, our official rate now is 4.15%. So we're the best part of 1% still below where we were when we peaked in 2012. You still with me?
Yep.
But our mortgage rates are 8.5%. So we're still 1% below where we were, the RBA number, where it was, at the previous peak of the cycle, and yet our mortgage rates are 1% higher. So the banks are making.
I've tried explaining this to people, Doc, and they're like, "No," and I'm like, the banks are cleaning up.
Yep.
Cleaning up.
Yep. That's it. And so they've made an extra percent, right, on their mortgages compared to 2012, right? If we look at the RBA average variable.
And not only the extra percent, their cost of funds has been way lower.
Well, they're paying 1% less, you see, in terms of official money. So official money's 1% less to the banks notionally, and I know there are swings and roundabouts here, but they're making an extra percent more. And, mate, that's big money, seriously. I mean, you think about it.
Across billions and billions of dollars, an extra percent.
Well, the point is, again, that the bank margins are increasing in a notional sense just based on the differential between the RBA rate and the average mortgage rate. And I know you can get less than 8.5% if you shop around, of course, for your mortgage, but these are just working on the RBA averages. And that's, as I said, a fixed measure that you can compare versus, a bank average mortgage rates, owner-occupier variable mortgage rates versus the RBA rate, and see how that's changed. It should really be the same, shouldn't it? Isn't it that if the RBA puts up rates, then the reserve, then banks follow, or if they fall, they follow down? Hasn't happened over that period of the cycle where since the last time we had an interest rate increasing cycle. So there's the answer to your question, Graeme. Yes, banks have been a little naughty, I think, there. And, again, it's the old hobby horse. We've got this conflict between, yes, we need a strong banking sector. We have a strong banking sector, only 4 banks. It's called an oligopoly. It has a lot of market power. It means they don't have to take risks, which means that they can make big profits regardless of the cycle, the economic circumstances. And they don't have to be risk takers like we see a lot of banks in the US, because it's a much different system there. There's a lot more competition, and we saw what happened as a result of that competition through the GFC period. But at the other end, Graeme, it's great to have all that market power, but you can't abuse it, mate. Do not abuse it. You have to also consider how important the financial sector is to Joe and Joanne Public out there. And you have to have part of your mandate, and having all that power that the government has given you, is that you have a responsibility to protect consumers and not, over-reap profits, if you understand what I mean. And I think there needs to be some serious questions there. Come on, Labor Party, aren't you on the side of the worker? Isn't it time that you looked at these structures that are, as I said, I'm not knocking the fact that we do have a very strong financial sector and an oligopoly in terms of just, very strong market power in a critical sector of the economy, but you still should have the responsibility of securing the needs and protecting the rights of consumers if you have all that market power over the financial sector, which we do have. So you see what I'm saying? You got to have the balance there, mate. And, who cares what the banking sector, the capacity of the banking sector and the ning-nongs that have sometimes been shown to run it. But as long as we have a bit of balance there between market power and responsibility to look after the rights of the consumer and not gouge, profits.
Yeah.
Particularly, in times of high inflation that we have now.
Absolutely. Well, Doc, you and I could talk about this all day, but a lot of people have been asking me this question going, things are tight. I said, not if you're the bank. You've got an even better margin than you had coming through the GFC. That's right. So there's your answer to your question for all the people that have asked that in the last few weeks. But Doc, before we get too segmented and segued, let's rip into the data. Let's take everyone, for all our YouTube viewers, but for everyone listening along at home, but for the YouTube viewers, let's jump in and have a look at the data. And let's see how we've gone over the last week or so, and what effect the chill is having on the market, if any at all. The winter chill, I mean.
Yes, the winter chill. Yes, Graeme, it's been a bit of a quiet week for data this week. We have come to the end of June, so we can see how our we do have exclusively in just a minute. I know everybody's has bated breath waiting for the data, but we'll go through that. But except for the data, it's been the housing market data on prices. It's been a quiet week for new data coming through. But that'll all change next week, Graeme. because we have a big week of data coming up to start the month. And, of course, that'll start off with interest rates. So the interest rate decision will come along next Tuesday, first Tuesday in the month. I thought it was interesting just to start with to just reflect on this month's decision, but the last decision, or the June decision, because we did get the minutes out recently from the meeting from the Reserve Bank. We discussed obviously in previous episodes we discussed the rate rise that the Reserve Bank was sort of sounded like it had become a bit harder in terms of its outlook to control inflation, that it was basically saying, look, inflation is still too high. We're concerned it's not getting better. It might be getting worse. So, bang, we're going to put up rates again. That was what they said in their announcement, basically for the June rise. But when we looked at the minutes, Graeme, I thought it was very interesting. And I think these are the main points. And I've just put that up there from the minutes that the bank said that it discussed two options, right, at the June meeting. First was put it up by 25 basis point, and the other one is to pause. So they had the two arguments, right? Now, the case for raising the rate was all about inflation, and that's what they'd said in their statement when they released at the beginning of June, when they announced that they were going to raise rates. They said, yep, look, we're worried about inflation. We're going to raise rates. We don't think inflation's getting any better, particularly services inflation, which is a concern. So to me, that sort of sounded like they were just, that's it. We're forget about a pause. We're going to increase rates and continue to increase them until we get inflation under control. So that was the case that they discussed during the meeting to raise rates. But then they had the other case, which was to have a pause. And they said that, look, there was a possibility that the interest rates, which they say have been a significant increase up until now, had already slowed the economy. It's just that we weren't seeing the results yet, and that maybe it was leading to the economy slowing more sharply than expected, right? So that was the other argument. Hey, it might be already working, but we haven't seen the results yet, and it might be working, too sharply in terms of creating an economic downturn. But I think the key thing was that they said that this is a very finely balanced argument in their opinion. So what I'm saying is I think that it was a close decision between, and they're saying that between putting rates up and pausing rates. So to my mind, that's still showing that there's really an inkling or a bias there that they want to pause rates, and that they're just really waiting for some data to support that. Now, they really haven't had the data over so far over June. As we've discussed, the employment market was very, very strong, Graeme. Unemployment rate fell, massive jobs growth. The number of unemployed also fell. It just couldn't have been a better result, really. And as we've also discussed, maybe some seasonal adjustment factors there that are part of that. But nonetheless, for those that were worried that interest rates, were perhaps already working and we hadn't seen it yet, there was no sign of that in the latest employment data. Now, we've yet to see the retail sales data for May. That actually comes out, Graeme, later this week. So that will be, and I think they're looking at that quite closely, the retail spending data, which has been flat over recent months. Again, we have to identify that there may be some seasonal adjustment issues here that are affecting the retail sales data. The ABS have acknowledged some difficulty with their seasonal adjustment, and that's because of the issues with COVID, the interruptions through COVID. So it's going to take a while to get those models effective again. Anyway, so those retail sales data numbers will be critical, Graeme, I think, because Reserve Bank has really focused on that, and they did in their minutes about household consumption, retail sales. So I think they're looking to that data. And if that is weaker, if that trend is really starting to consolidate of recent months and is a weaker data set over May, then I think, we are really getting closer to a pause, regardless of the sort of the labour market strength. although that certainly is an offset. So I still think it's very finely tuned in terms of the mindset of the members of the Reserve Bank board. And I think that, still, I'm going to wait to see those retail sales data, Graeme, before I give an opinion. But I do think I think the main point is this is a finely balanced focus from the Reserve Bank. I think they're looking for an excuse to pause. And if those retail sales numbers are down, I think, they may just shift across and have a pause. And the other thing we need to remember is the US paused, Graeme, last week. So the US, the week before, the US have now paused for the first time since January last year. And although, the economies are different, the big picture is that we're starting to see that sort of pausing energy work its way through a number of advanced economies, with the exception of the UK, which is a basket case at the moment. They actually put up their interest rates by 0.5%, so they went hard because their inflation is basically out of control. So, let's forget about the UK, but other similar advanced economies to Australia are just sensing also that a pause might be closer than we think, and the US have already done that, although they have acknowledged that they expect to raise rates again over coming months. But again, it's all about the data. So I thought we'd put that one in, Graeme, to set the scene for the decision next week. And this is what the RBA said in regard to inflation, of course, and that was that although it's past its peak, it's still too high. It's going to be longer before it gets back to where the target range is, which is 2 to 3%. They're putting up rates to make sure that occurs in a reasonable time frame. And this was the statement they made on the day that they still think the risks to inflation have increased, particularly for services inflation. So, and they also mentioned that wages are growing briskly, but not getting the productivity growth reflecting wages. And that basically means that you're getting a pay rise and you're actually not earning it, because it's not about producing more goods for your work, for your boss. It's just because, you can get a pay rise. So you do get a pay rise and they have to cover it because of a lack of workers going around. So we set the scene to start with about interest rates, Graeme. We've had a long discussion on that. And, we await with bated breath, don't we? Next Tuesday's announcement by the Reserve Bank. Will they pause? As I said, let's wait for those rails.
I think I got to call it. If they pause, I think it'll give a false sense of security to the market and people will go out spending like drunken sailors again.
Yeah.
The average person doesn't understand the economic argument. I don't want rates to keep going up, but I want them, if they're going to keep going up, I want them to go hard and fast, because the quicker they do it, the quicker they come back down. But this, and as we have been, quickly, we need to get it under control. And the only way to do is go hard. Like you said, don't stop and start. It's not pumping the gas pedal and back and just get it done. Yeah. Let's get control. Let's settle down, because then hopefully they'll come down just as quick as they went up to some extent.
Absolutely. Yeah. And that's the offset, that you can always put your foot on the accelerator if you need to, and cut rates, I also think it's just, I think there's a little bit of, there are issues about a bit too much focus from the Reserve Bank on housing market activity. Yeah. This has been a hobby horse of mine for a number of years. I think they are too focused on what's happening in the housing market. That's a peripheral issue. The housing market follows the economy. We've seen that over the past year. It's why we've seen a revival, because the economy is strong. Yeah. And all the nonsense about high interest rates cracking the housing market, well, that hasn't happened again. It never has happened, but it doesn't stop, the pinheads out there predicting doom and gloom with higher interest rates for the housing market.
Maybe the pinheads can ignore that argument, Doc, because the rates have not been affecting the housing market for a while now. So, and it's proven right now it's still going up the last 4 or 5 months. So maybe the pinheads can pull that argument out, focus on the actual economy, the important data sets as you do, and ignore that, and the housing market will just be the housing market.
Exactly. It follows on, of course. It's very hard to consider buying or undertaking the biggest purchase of your life if you haven't got a job. But if you're getting, 5-10% wage rises, well, maybe 5%, and the boss loves you and there's plenty of work around, well, you're starting thinking about wanting to spend that money, Remember, not everybody has a mortgage, Graeme, and a lot of people who take out mortgages only take out small mortgages, so they're not as affected as we may think about higher interest rates.
Yeah, hardly anyone, Doc. Like 25, 30% of the market in Australia residentially has a mortgage, and the ones that do aren't that big.
That's right. So, it's all about have a cold shower. But, I mean, the cold shower for the doomsayers has happened over the past 6 months. They're all wet, and we move on. And like I said, if we get a pause, that's almost, with a strong economy such as we've got now, that's almost tantamount to a cut in interest rates, because this economy is stronger today than it was a year ago when we were into our second rate increase. And really, it's as strong as it's been, despite all those increases. But again, as I reiterate, we started at zero. We're still the best part of 1% below where we were at the previous peak. These are still historically low, in terms of averages, interest rates that we have. And we have such a very, very strong economy, with even more demand coming in through migration. So we've had I didn't think we'd speak this as much as this on interest rates, Graeme, because the main game today is house and unit prices surge. I'm using that word advisedly.
Pardon?
Surge over June.
Surge,
yes, surge. So these are the latest June quarter house prices and unit prices from My Housing Market. We take a quarterly snapshot of housing market activity, Graeme. It's very robust. We take a lot of observations. We're looking at around about 10,000 observations per capital city, a little bit less for the smaller capitals over that 3-month period. We then compare it to the previous monthly 3-month period. So that's the May quarter. So it's May quarter versus June quarter, and on we go. So we track it on a monthly basis. And when you look at the other data sets, we're very close, if not identical to what we're seeing from other home price modelers. So let's have a look at June. Surging results over June. National housing market continues to report strengthening results. Home prices rising sharply again over the June quarter. The national house price, Graeme, has now increased over 5 consecutive months. So let's have a look at the data. And this is the chart for the national housing. Yeah.
Wow.
Down she went and up she came, right? And there we are. Yeah, so you can see that clear revival. There's no a one-off here. This is a very consistent trend, a very consistent trend. And we were really talking about this as far back as last September, Graeme, because we said that even though prices were falling, that the rate of decline was actually easing. So it wasn't falling by as much from September onwards. And eventually it was, as predictable as anything, because we saw it just bottomed out and up she's come, right? And there we are, five quarters in a row, monthly quarters in a row, Graeme, of higher house prices. Absolutely no doubt. Even the Reserve Bank said that they were clear, that house prices were rising everywhere. So, by geez, did they get that wrong in terms of their predictions? But they weren't alone there. So this is the data, Graeme. Look at Sydney. The Sydney market. Wow. Sydney house prices. Now, this is month per month. So Sydney median house prices, and these are mix adjusted. So they're a very accurate data set, very robust and reliable data set. 2% increase, Graeme, over the month in Sydney. And so far this year, Graeme, yes, hang on to your hat, up 6.8%. So at the halfway mark of 2023, Sydney house prices have increased by 6.8%.
Now, I don't know if you remember, Doc, but there was very strong predictions of 10% house price crashes in 2023 in Sydney, Melbourne, Brisbane.
Yeah,
yet
plus.
Halfway through the year, we're up 6.8%.
Yes, that's right.
So they're currently incorrect 16.8%.
That's right. But it's the wrong direction, mate. It's the wrong direction. That's the real point here. You know, you want to at least get the direction
not only
right.
are they wrong, they're wrong in the wrong friggin' direction.
That's right. Get the direction right. Can you do that? A lot of those financial journalists and gurus who are predicting all this stuff, they don't just say a word about it anymore. It's like, whatever you do, don't talk about the war. You know what I mean? It's like, don't mention the housing market. But 6.8%, Graeme, remarkable result so far this year. And the Sydney market is now just 1.5% lower than where it was in June last year. And of course, June last year, we were plumbing the depths of despair in terms of the second interest rate increase. Clearance rates were falling. But we're just in Sydney is just 1.5% lower than where it was in June last year. So very strong result. The median is now over 1.5 million again in Sydney. And that 2%, with the exception of Canberra, which is in a bit more of catch-up mode. But Canberra's been very strong, and we've acknowledged that over recent weeks, and that increased by 3% over the month or the quarter compared to the previous monthly quarter, which was the May quarter. So Melbourne up 0.7%, Graeme. It's also up 2.6% so far this year, house prices. So it's on track for what we predicted, which was around about a 6 or 7% increase in the Melbourne median house price. Brisbane continuing to rise, up by 0.8% so far this year, up by 1.4%. Melbourne's just down 2% compared to June last year. Brisbane market's down, but we know that compared to last year, but we know the Brisbane market continued to rise last year, while Melbourne and Sydney were falling because that had a late easing of its cycle. Adelaide up 1% so far this year, up 2.1%, and flat compared to the same period last year. Perth's been a big mover, just up 0.8% over the month, Graeme. But Perth's still up 4.1% over the year, but it's up 4.4%. This year so far, but up 4.4% over the full year. Hobart's been the underperformer, really, Graeme, up slightly over the month, the quarterly month. This year down 3.6%, and over the full year 10.5%. So Hobart, as it tends to be, has been a little bit of an outlier, not just in terms of its results, but also tending to go the other way compared to the other capital city markets. Canberra, we mentioned, has had a good month for house prices, up by 3% over the June quarter compared to the May quarter, up by just 1.3% this year so far. But it's certainly been in a revival mode, as we've seen over the last couple of months with auction clearance rates. And Darwin, again, a market that tends to be volatile because of the smaller numbers. But again, I think what this represents, Graeme, fundamentally is obviously we're in a revival mode. All markets recorded an increase in prices over the June quarter, so there's some consistency there. The big markets are certainly Melbourne and Sydney are closing in on the lows of last year, so they're heading towards peak prices again, record prices. But what it does is, we talk about our auction markets every week, the weekend auction markets, and we were talking about the B word for Sydney, the boom word during June, and this is reinforcing just how those high auction clearance rates, rising auction clearance rates to above 80%. It just shows that it's now reflected, as it always is, in what's happened with house prices, with a very, very strong result there in Sydney, and strong results also in the other capitals, including Melbourne, which was also pushing well above 70%. So good news there if you're a homeowner, Graeme. Also good news for those who predicted catastrophic falls in house prices this year. And of course, we've still had interest rate rises all the way through except for April. So they can't say, it's because they stopped raising interest rates. They've continued to increase interest rates. So the methodology and the modelling of those that have made these negative predictions based on interest rates is just cloud cuckoo land stuff. And all they had to do is look at history, and they would have seen that there's not a relationship between the two. Certainly not as strong as being promoted. So units, Graeme, units also are up over 5 consecutive quarters as well. So the unit market.
But units don't make any money, Doc. They don't go up like houses.
Well, they're making money there, mate. In fact, if you look, we're very, very close to the national unit price recapturing where it was a year ago. So it hasn't had quite the declines that houses have, the units, and they're certainly also experiencing a sustained revival going forward. So let's have a look at the unit results. Again, Sydney, strong result, 1.1% increase, Graeme, over the quarter compared to the May quarter. Units up 4.4% in Sydney, so good results there for Sydney. And just about, well, we've got 2 year, that should be 1 year, sorry, that's a typo, or for both year and year, that's this year so far and the full year. But you can see there that over the year so far, 4.4% higher for Sydney, and over the past year, just about back to where they were. Melbourne also higher. This year so far, Melbourne units up 1%. And Brisbane also higher, up 1% over the quarter. And this year so far, up 2.9%. But you can see there, Brisbane and Adelaide units have continued to grow, up 5.9%. As I mentioned, that should be 1 year, not 2 year, up 5.9% over the past year. And Adelaide up 9.5% over the past year. And Perth also units, but these are smaller markets. Smaller markets of Perth, Hobart and Darwin tend to be quite volatile, Graeme, because there's not a lot of units there. So we need a bit of a longer snapshot. But still, nonetheless, those big markets of Sydney, Melbourne and Brisbane have produced good results there for those, that are unit owners. And, of course, this is a positive for all those investors out there that have units, that they can see that they're not only getting high rents, and we'll have our rent report out. We'll have the rent report maybe next week, maybe the week after. But not only are they getting high rents and rising rents, but they're also now getting the capital growth coming through, in that unit market, which is particularly favoured by investors. So that's all the latest data, Graeme. Very positive news and we're not surprised because we knew that was coming given our auction clearance rate stories. So let's have a look at the weekends, the last weekend of June, the beginning, I guess, notionally of the winter selling season. And as I mentioned, school holidays have started. We saw those results reflected in the results at the weekend with lower auctions, but an interest but also clearance rates down a little bit, but still quite strong in the major capitals. Sydney and Melbourne still around the 70% mark, but significantly fewer auctions there. And, of course, way ahead of where they were a year ago anyway. And Brisbane higher clearance rates, but fewer auctions given school holidays. Adelaide, it goes into school holidays next week. Their auction numbers were around about the same, and a strong clearance rate. And Canberra, of course, was also fewer in terms of its auction numbers. So no surprise there, Graeme, that we're starting to see an easing in auction activity because of the school holiday period. And we'll, await the results coming up this weekend when, again, we'll see certainly fewer numbers of auctions, particularly in Sydney with school holidays commencing there. And interesting to see what happens with our clearance rates. But it is the pause period. We've pressed the pause button, Graeme, mid-year. And after those results we've seen over June, I'm sure there's plenty of confidence that we'll continue to see a strengthening housing market once we move through the midwinter period. This is the data. When we look at what's happened over June, we can see strong results there compared to June last year in the Sydney market. And that's the trend that basically follows what we've seen with prices, Graeme. Clearance rates rising, prices rising. Similar in Melbourne, just eased a little bit over with those weekend results, holiday results. Brisbane's tracking still quite high there at 70%. Very encouraging for Brisbane. We've been saying that the Brisbane market has certainly shown clear signs of a quick rebound, Graeme. It's had a very shallow decline period following its boom last year. and it's back now to growth, and those auction clearance rates are showing us that. Adelaide still around that 80% mark, very strong auction market traditionally. Adelaide and Canberra, as we mentioned, has also picked up over the year and just easing a little bit at the weekend. Next week, Graeme, as it comes, we're into July. So we're into the second half of the year, Graeme. Can you believe that next week? Lots of interesting stuff, lots of data coming through. The July interest rate decision, which of course we will discuss. Will we have a pause? Very interesting. Building approvals coming through. Will there be a revival in building approvals? The answer to that question is no. That's not going to happen for a long time, in my opinion. Retail sales, we've discussed retail sales. We'll also see the latest home lending data, which we may have a bit more of a look at this month to see just how first home buyers are going, Graeme. So we'll look at that first home buyer market, and we'll have the first July auction results when everybody is on school holidays.
I don't expect too much out of that for July, but we'll see. We'll see.
Yeah.
We'll see.
All good. It's been a big show today, Graeme. Lots of information, and of course, exclusive to everybody today is the price data. So as you'll see when the other data sets come out next week, that they'll be very similar, if not identical, to what we've produced. And we produce a median price as well as just the numbers, so it's not just an index. So we give the full story there and the results over the year and the year to date as well. So my voice needs a rest.
There you go, ladies and gentlemen. Thanks as always to Doc. And I tell you what, you've got it here first. End of financial year data. So there you go. Let's see how long some of the pinheads and some of the gurus and experts take to come out with their data, but you've got it here first, and it's bloody accurate, and it has been week on week on week. So
yes, Graeme.
As always, Doc. Sorry?
That's right. I was saying yes, Graeme. I mean, I'm in non-stop talk mode, I think, at the moment. But
that's all right.
Pull the key out.
We're getting a bit excited for end of financial year, Doc. It's only normal. I mean, I haven't slept for the last 3 weeks coming into end of financial year, trying to get everything done.
It's all good. All right, mate.
We'll see you next week, Doc.
Yeah, lots of information next week, and keep on keeping on.
Looking forward to it. Thanks, Doc.
See you, mate.